Welcome to Venture in the South. These are the stories of innovation and success in the southern U.S. that make money, have fun, and do good.
Welcome back to Venture in the South, a podcast about angel investing in the southeastern United States. On this week's episode, I am joined by Josh Rollins. Josh is the founder and leader of a platform called Vicinity Capital based here in Greenville, and wanted to give him the chance to meet listeners and tell you a little bit about what he's working on and what the crowdfunding approach to angel investing involves. So Josh, welcome to the show.
Thank you, Paul. Good to be on.
First question is usually an easy one that I give people. Just tell us a little bit about you and your background and what brought you into the podcasting studio today.
Sure. Well, I graduated with a music degree, so that should be a very easy connection to see how I'm here today. Just kidding. But from college, went into a pretty early business that was set to grow pretty aggressively. And during my time there, worked in a variety of operational capacities, but ultimately landed in finance as I worked on my MBA in finance and my CMA. Got some of educational chops, but really more of the School of Hard Knocks as we grew from one state to 38 states. And I led the finance and technology departments at that company, and also did some M&A work for a few years as the company grew through some private equity and some targeted acquisitions, in addition to the organic growth. So that was about a decade of creating a lot of the skill set and wherewithal in finance that then I brought to founding Vicinity along with my business partner. And that is what led us to be established here in Greenville as our home base for Vicinity. And I'm sure we'll talk more about that, but that's a little bit about me.
Okay, great. Let's just jump into what does Vicinity do?
Sure. Vicinity was created to be at the center point of where this trend in decentralized finance was meeting I'll call it a new localism, but you could view it in a lot of different ways, a pride of place, a different overall feel to where people wanted to live, work, play, that were outside of maybe the big primary markets that we might think of, but getting into secondary and tertiary markets like a Greenville, or I think we can think of Chattanooga, a variety of other cities, particularly in the South. This is where I've always lived and worked and where my family is. So we saw those trends coming together in a way that wanted to answer the question of what's going to happen with investing and how might that be localized. So down the rabbit trail and rabbit hole we went to look into the regulations around different securities exemptions, things that I wasn't overly familiar with, go back about 7 years. And through seeing some of the changes in the legislation that really opened up doors, particularly for non-accredited investors and for public marketing around offerings that hadn't really existed since the establishment of the SEC. That really was where the final piece came into play to say, not only are the economic trends seeming to point in this direction for decentralized, localized, alternative investing, but the regulatory side opened up the doors to make it legal and functional in a way that it hadn't been before.
Okay, got it. So we'll dig into all of those pieces as we go, but maybe let's step up one level and just explain to people what crowdfunding as a whole means and what the different flavors of that are, because people have different exposures to different kinds of crowdfunding. So I just want to sort of recap that for people so they know what we're talking about.
Yeah, good question, and very helpful distinctives that should be made. So most people, I think when you think of crowdfunding, you're going to think of either GoFundMe or Kickstarter. Those are two versions of crowdfunding that were maybe the earlier of the versions. So GoFundMe would be a donations-based type of crowdfunding. Kickstarter would be what I would call a rewards-based type of crowdfunding. You'll see different products and things, but usually you're getting something of a reward or a product for an investment used very loosely in that regard. None of those are truly investments. And then what you have really starting in 2017, technically May of 2016, but momentum started to build as you got into 2017, was investment crowdfunding. So true securities offerings where you are able to sell equity or debt or a variety of combinations of securities in the company that you're building to raise capital and deploy it. But now you're dealing into a different tier where you have to go through securities law. You got to be thoughtful of how you're taking care of investors and all of that. So Vicinity is a registered investment platform. So a RegCF or regulation crowdfunding investment platform registered with FINRA and the SEC to do the investment side of the crowdfunding world.
Okay, got it. And so the key new things there are anyone can do it. You don't have to be accredited, and you can talk about these deals publicly, right? Those are two of the big building blocks to allow this to happen.
Yes, that's a great way of capturing it. Those are the two that I think are most important.
Okay. But because of those things, the SEC say it can only be done in certain places. And so you are one of the places in which this can be done, or through which this can be done. Okay.
Exactly. It needs an intermediary.
Okay. And it, I assume, didn't happen overnight that you were able to set that up. And I also assume you're not the only one that's done that. So how has that market kind of grown since 2017?
Yeah, that's a good question. There were, I would say, dozens of portals that were established that went through the funding portal process with FINRA and with the SEC. Not as many started to be very active in the space. So I'd say there's probably a dozen that are doing something. Some of them are still fairly small. And then there's a few that were the early movers and shakers, particularly in Silicon Valley, and were very helpful with the lobbying efforts and getting the exemption to a launch point. And they hold a pretty significant chunk of the market share, but also go about it in a way that is one angle of the space. And I think as it has developed over the last 7 or 8 years, we've seen the market get to a place of a little bit more maturity where there's unique positioning in the space, which the reason we jumped in with Vicinity was because we saw an avenue on the local alternative asset, particularly in the Southeast, that was not being addressed as well. And I don't think can be by the bigger Silicon Valley players. So I think we fit a unique niche of the market that has a ton of potential really across the country, but this is home base and where we're seeing the first ripple effects here in the South.
Okay, got it. Definitely want to explore how the Vicinity platform works and the other players. I just want to step into the shoes of an entrepreneur for a second. So why, as an entrepreneur, would I consider this as a fundraising option?
Yes, I think it is a great way to apply a little bit of a megaphone to your your funding efforts. As you're looking to raise capital, a lot of people either have or need, even with crowdfunding, you need some early momentum, some early, we'll call it lead investment that can take different shapes and different types of raises, but the concept still applies where you need that early capital that can get things started and can be a good screening, vetting tool for you from the market. There's other ways to screen and vet, of course, as Venture South knows well. We have a process as well for that. But when you have that early momentum, that doesn't necessarily get you to the capital goals that you need. So when you can leverage a broader network or a strong brand to add on top of that early momentum, you can get to capital goals that otherwise you wouldn't be able to achieve. Yeah, so right. I think there's that public nature and the open access, as many may or may not know, non-accredited investors were usually locked out of alternative assets. Outside of these particular types of regulations, that's 95% of the population. So you have a lot of people that would write smaller or mid-sized checks, but that's still a huge audience that you can now try to appeal to for your capital raise.
Okay, got it. And I assume that those are, for the most part, still people you already know in some capacity. They don't have to be, but they're people familiar with your brand or you know them, and this gives you another way to engage with them and perhaps keep them stickier. So I assume that, for example, if you're a company selling something, you have stickier customers if they are also your investors. That's right.
Exactly. And you get a lot of new contacts through something like this too. So especially where the industry is now, a lot of people understand that this is an option. It's still fairly new, obviously, but a lot of people understand this is an option and are looking for deals that otherwise they would have no idea exist or would be locked out of from some of the other securities exemptions. So there are people looking for opportunities that fit a market they know or like. And so it can expand your brand reach as a marketing campaign addition to your capital raise.
Okay, got it. And then to back in the investor shoes, if I'm not accredited, I really can't do this in other places. So this is a tool for me to dip my toe in the water of investing in private alternative assets, right?
Exactly. And there's specific guidelines around how a non-accredited investor can participate, but our technology platform makes that very, very seamless for somebody to come in, learn how to do what they can do, and understand what those parameters are in a way that's very guided and controlled so that they can truly, I think, dip their toes in is a good way of describing it.
Okay. And so just briefly, what are those rules around how much an unaccredited investor can do this?
Yeah, there's a slightly complicated formula, but it's a calculation based on your net worth and your income. As you might imagine, when the SEC puts some of those parameters around, it can be complex. But the way that it works on the system is very easy. You can enter net worth, income criteria, and it will guide you and say, hey, this is how much you can invest on an annual basis via regulation crowdfunding. And then we'll help to control that as they make investments through the platform.
Okay, got it. And if I'm an accredited investor, then this still is appealing, I imagine, for a couple of reasons. One is more deals, and another, I would assume, is a broader variety of deals than perhaps I have a network to source myself. Is that why accredited investors use it?
Yes, I think two things come to mind as we've worked with. There still are many accredited investors, still a huge portion of the dollars invested in any deal are still accredited investors, while also non-accredited get to participate and make up a good portion of the population there. But the reason that accredited are participating as well, one, it's very easy. This is maybe one, when you apply some new technology tools and this process, I think it's probably the easiest way to invest. So it streamlines a process that has been growing more and more antiquated over time. Maybe that's controversial to say to you, or maybe you would fully agree, but there's opportunity there to make it very, very easy. And additionally, they are seeing deals. So think of lower middle market real estate deals or operating businesses that are looking to grow. Some more cash flowing types of alternative assets can be in play here, in addition to how they might participate in a venture deal through Venture South. We wouldn't do as many of those types of deals. And so we build our density and opportunity around those other asset types.
Okay, got it. So let's explore that a bit more. And you touched on this a bit already, but what kind of companies or capital raises are particularly suitable or well matched to using a crowdfunding audience or platform?
Yeah, I think it may be a softer criteria, but one that's most important would be community resonance. Is what you're pitching something that would actually speak to and resonate with those that you would be marketing this to? And if it's easy to get, I understand that and it makes sense. So with our approach to particularly trying to find investors that are local to a deal, that could be regional, that could be state, that could be city. When you understand, besides just the zeros and ones and spreadsheets of analyzing a deal, if you see a real estate deal and know that, hey, in this market, on that street corner, or with the needs that we have here, that's just going to be a great fit and will fit a need, then you're able to participate in a way that is exciting, and the issuer is able to leverage that resonance and show that they're solving a real problem. If it gets too complex, or you have biomedical engineering and you need very specific expertise, then a public raise may not be the best option. Brands that have built up a large following, that could be social media, it could be customers, it could be just community members that really like what they're doing. It's not the same as an investor, but it's a very good starting place to say, let's get a broad net of reach and then talk to those and explain to them what the investment mechanism is and make your case for it being a marketable deal that is worthy of raising the capital, and you can convert a lot of those.
Okay, got it. I assume that there are some potential drawbacks along the way. So maybe let's explore some of those about why this is maybe harder for entrepreneurs than they might have thought so far through the podcast. You mentioned one, so it doesn't really necessarily find you investors. It really relies to some extent on you bringing your network and your investors to the table in the first place, right?
Yes, I think there's the build it and they will come mentality should be deleted upon entry. Just having a page that's on the internet will not do you any good. So you have a tool, but then you have to figure out how to strategize around using that tool and get it in front of the right people. So it's still capital raising. Capital raising is hard. It's a lot of hard work. It is a full-time job. I think what a platform like Vicinity can do is make it a high-intensity part-time job, and you have a capital partner in the mix who's thinking about a lot of things that you might not, and helping you with the regulatory, some of the marketing approaches through investing or for investing, and having just some collaborators around the table that become a team to help you in what's still a lot of hard work, and you still have to pitch, you still have to sell people on your vision. I can't do that. Vicinity can't do that. It's your company and your vision that has to be cast, and really what's going to get people to make a decision to invest. We just become a big support network.
Well, the very least, having a support network helping those entrepreneurs is a valuable thing.
I believe so.
On the other hand, you're now building this in public to some extent, or you're fundraising publicly, so everybody can see when your commitments are, $100 and not $100,000. So how does the public element maybe give people some pause when they're fundraising?
Yeah, that's a great question, Paul. I think one of the better tools that have come out as this regulation has evolved is a testing the waters provision that allows for an issuer to have a marketing page where we would collect indications of interest and build that investor pipeline a little bit more quietly. So you still have a page out there that's saying, hey, we intend to raise capital this way, and we're gauging interest. If that interest goes really poorly and nobody signs up and all we hear are crickets, then you just take the page down and move along and hopefully learn something along the way from that process on your terms, on the residents, on what people didn't understand. And so still can be useful, but might be useful in a way to say, don't raise capital this way. If there is good momentum on testing the waters, that's when you would look to actually file with the SEC and go public and start accepting checks and subscription agreement signatures, all that fun stuff. If it gets to enough momentum to do that, the goal then is try to build momentum quickly with the live page so that you're seeing excitement kick in and validation from others participating. That can be very helpful in driving the public offering. If in the case that it just doesn't go well, either IOI's indications of interest are not being converted or something big just happened between when you filed with the SEC and what's going on in the economy, and it just doesn't work, then you can withdraw the offering and it goes down from the page and you move along. So it's still public. There's still people that would know about it. I don't know that it's drastically different from if you were having to pitch to investor groups around that are going to know that you were out there doing it anyway. But there are some mechanisms there to try to control the release and what information is truly being made public in a way that hopefully can lead to the most likely chance for success.
Okay, got it. And then we also have to talk about the costs of doing things. So presumably it's not free to do all this. Are the costs, in your view, reasonable versus what you get for that fundraising? And how well aligned are the costs with getting to a successful fundraise rather than just paying somebody a retainer?
Right. There is a little bit of upfront cost, but it's pretty minimal to get for what you get on building a page, having a strong pitch, presentation, investor pipeline tool. All of that is a smaller portion. The majority of the revenue for really any crowdfunding platform, they're pretty aligned across the industry. It's contingent upon success of the raise. So you build it into your modeling on your use of funds. This is what we always encourage issuers, at least. Think about this as a cost of the capital raise. And upon success, you have the money you need to go and put to good use. And then you're able to pay the provider, which is different than attorneys or CPAs or others that are all up front. So I do believe that's very aligned around the goals of the issuer. It's very friendly to founders, and it drives a lot of marketing benefit as well that I think is worth considering. I think it's important to view this as a marketing expense in a lot of ways, as well as cost of doing a capital raise.
Just very ballpark, I'm sure it varies between providers and situations, but what should an issuer, an entrepreneur, be expecting to pay for this process?
Yeah, I think it's good to plan on about 8 to 10% of the capital raise. That'll capture costs that aren't just on the platform, but things, legal, accounting, other things that you might need to do. It'd be good to budget that. And then for us, for example, we'll take some of that in cash for our portion and some of it in securities that are being offered. So it's not a cash outlay for the issuer, and it's aligned incentives for us with the investors and the issuer. So there's some creative ways to continue to manage that, but I think that would be a good target to say what you want to think about for how you want to run a successful raise and have the right people involved to meet the securities requirements and to really drive as much success as you can.
Okay, got it. You did call angel investment antiquated earlier in the show, so I'm going to keep beating you up again in a minute, but I'll give you a break from that. Can you tell us a bit about a success story or a deal that's been through the Vicinity platform that you're proud of or people would have heard of or that you'd like to highlight in some way?
Sure. That's a fun question. And there's a few that come to mind, but one here in Greenville that was very exciting, got a lot of people involved and maxed out the amount you can raise via RegCF in a 12-month period, which is $5 million. And then they continue to raise after that, was Trueline, a new event venue, particularly around music, but a lot of other events that fits a real need in downtown Greenville. It resonated deeply with the community. The founding team is very strong in their background in the space. And that one just generated a ton of excitement and interest and a unique investment opportunity that almost every investor that participated saw as, I never get to see something like this. This is pretty cool. And it brought in very significant investors too. I mean, sophisticated investors who are now helping to be strategic partners in the continued development in a variety of ways. As you might imagine, that has a lot of moving parts and pieces. So building out that team of vested brand ambassadors, from the ticket buyer who will spread the word to somebody who might have strong connections in related spaces, that was very exciting. If I could say one other example that would be very different from that, is a local membership-based pool that wanted to raise capital and had a few neighborhoods that would benefit from it. Their home values, just the lifestyle of having access to that pool, and they wanted to build one, and decided to put together an offering for a note, just a simple debt instrument where people could get interest on it, but at a cost that could be managed by the pool. And it allowed for them to get their investor perk was access to membership. So by the time they had their investors that allowed them to build the pool, they also had a fully functional operating model of enough customers to make the model work and to pay the debt. So
yeah,
a lot of the investors in it were able to cover their membership costs annually of the pool by the interest that they were getting on their investment. But that was a 7-figure raise, all from one zip code. So a very hyper-local, different example I never would have pictured when getting into this business that would be on the other end of the spectrum from a true line.
Okay, very neat. Both of those are bigger amounts of money than I would have guessed. Both of them have the local angle that is consistent with what you've told us already, but the number of people and the number of dollars involved there is surprising.
It is. I think part of that's our approach. We're different than the industry average on a lot of these. So we have a higher average raise size, higher average success rate on how many deals successfully get funded, and a higher average check size. So all of those are a little unique to our model when looking across the industry. And I think that further proves the point of what I was saying on there's different areas to fill using the securities exemption. It's not a one-size-fits-all tool for, I think, geography or industries. And so that is a little unique to us, I believe.
Okay, got it. I'll give you another chance to tell us how good Vicinity is versus your competitors in a minute, but I'm just going to beat you up for a minute on the criticisms that you hear sometimes about crowdfunding platforms from the investor perspective. One of those would be that the entrepreneurs that raise money through them are less accomplished or less effective, or couldn't raise money from sophisticated investors. So they are raising money from unsophisticated, gullible, easily misled investors, and fraud is rife. Is that true, or justified in any way, or just an unfair accusation?
In my experience, I would say it's untrue. Maybe it is on certain platforms or in certain types of deals, but the deals that we focus on, the screening that an issuer goes through, we launch about 5% of the deals that come across our desk, and they have to really know what they're doing. And I would also say that the majority of the investment dollars are still coming from sophisticated accredited investors this isn't their first rodeo. This isn't the only thing they're invested in. Most of the times it's not the only asset in that asset class they're invested in. So they ask good, hard questions, and to get them to write large checks that, like I mentioned, drive up the average check size for our platform compared to others, it takes you still having to pitch and present in a lot of the same ways. You just get the added benefit of the public nature, the marketing, and non-accredited investors getting to participate alongside.
Got it. I don't think there's any data to say that the fraud levels are higher in public raises than they are in private situations. I feel like in general, the rates are pretty low across the board. So I think that probably is fair.
Yeah, I would be as bold to say that they might be lower. I think the SEC expanded the opportunities there in RegCF a handful of years in. I can't remember exactly what year it was, but a few years in, to have higher raise capacity for issuers, higher investment thresholds for any individual investor. And that was because it was working very well and there was no fraud. I think the way that it's been structured, it's newer. It has a lot of different tools, and having like an intermediary there as well, like a Vicinity, I think helps to guide some of the things that could otherwise intentionally or unintentionally cause issues that an issuer may fall into.
Okay, got it. And another complaint is that the reporting's not very good. These companies raise money in a crowdfunding situation, but then never tell anybody what's going on. And from personal experience on a couple of platforms, I can attest that there are examples of that because I've had them. What is the reporting requirements going forward, and is that a fair criticism, generally speaking?
Yeah, I think there is an annual report requirement for any issuer that raises capital this way. So that would be within a year of completing a successful capital raise. They have to submit a fairly extensive update to the forms they filed when they originally raised capital, financials as well. So that's almost the 1 year check-in mark that is a regulatory requirement.
Okay, and does that go to the SEC or just to the...
It does.
Okay, so in theory, I should be able to go get that for the companies that I invested in and haven't heard from to see how.
It should. Okay. It would be fair, though. There are a lot of companies who haven't timely filed those. That has been something that has come up. We strongly recommend best practices of quarterly reporting for the issuers that come through our platform, and we even assist them with that. So I think we probably have a more communicative group, but I do think it's fair to view this, what I believe would be similar to kind of early angel rounds, maybe not true venture rounds, but those issuers who aren't familiar with this process yet and how to take care of their investors. And so I think it would fall into a similar category of that as a learning curve. We try to help with that education and really help connect the dot that this should be the time where you're most effective at this. Even though it's new, your incentives are very high to get this right and have a good reputation as an issuer on taking care of your investors, because you'll likely need to raise money again. And you want those investors to follow on, and you'll need to expand the investor base. So having a good reputation there, in addition to trying to perform well as a business, will go hand in hand to your success down the road. And that clicks with a lot of our issuers, at least.
Yeah, no, that's fair. We certainly have a challenge getting information out of companies in the angel space as well. So I'm not saying that is unique to the public space. There's a lot of learning that goes on from new entrepreneurs on how to improve all that. And it does matter going forward. Yeah, it's much harder to raise money from later investors if you have not told your current investors what you've been doing. All of that resonates with me. Another complaint is that this can mess up cap tables, that having lots of unaccredited, particularly, but just lots of people on a cap table makes it harder to raise money later. Is that still a concern, or is that a non-issue at this point?
It has thankfully been, there's been an opportunity to make that a non-issue if issuers use a special purpose vehicle to aggregate all of the investors, or at least all of the non-accredited investors. So that shows up as one line on the cap table. That was a great improvement that came out from the SEC, I believe, in 2021. I think that was when the limits increased as well. So that tool has made it to where it should be a non-issue unless somebody chooses not to use that.
Okay, got it. Well, I think you've done a good job there responding to the potential criticisms. So I'll ask you a more positive question. So how do you characterize the difference then of Vicinity versus other larger platforms like Start Engine and WeFunder that people may have heard of? How is Vicinity different from the market as well?
Sure. Great question. And some of the stats I mentioned maybe support the results of us being different, but don't necessarily get to how or why. So I believe that our approach is more of I'd say a curated boutique type of approach where we're getting to know the issuers fairly well in the process. We're meeting with them regularly as they plan out their offering, and partly to try to help them be successful, but also it's part of the screening on understanding how they're thinking about this process, how they're going about it. Are they executing well on some of these basics that would then lead to hopefully a successful raise, but beyond that, a successful investment cycle and period that those investors are involved. So I think that drives a different focus from us as a platform. The others that you mentioned and others in the space, they're going to have a very similar tool that follows the FINRA checklist of requirements on what everybody has to meet. So price of entry is having good technology that can facilitate this well and be very secure for investors. So beyond that, we were looking and saying, well, we need to do this differently. The Southeast is a different market. Money works differently. There's different investment opportunities, asset classes, types of businesses that are operating here. We want to serve them well and uniquely. And I believe that has helped us to have north of 90% success rate versus an industry average of around 50 to 60%. So it's way less transactional on our part and more of a real strategic partnership through that successful raise. I think that's the umbrella that I believe captures the difference. Within that, there's a lot of things that will happen in those conversations that I think help to shape an issuer's approach to raising their.
Okay. Got it. How about the density of deals? So how many of your companies or your listings have been in Greenville versus other places? And does that density help with the fundraising between them?
That's a great question. That is part of our strategies. We want to see a higher density of deals and investors in a particular geography so that they can build a local portfolio, not just one-off deals where, again, back to that transactional mentality, this is more of a true opportunity to view a local asset class as a good differentiator and a way to add into your portfolio. So to do that, we need a recurring cycle of deals and investors that want to participate in those deals and grow, and a little bit more of that pebble in the lake kind of ripple effect versus just opportunistically wherever a deal may pop up. So Greenville is home and where we started, and that's where most of our deals have been, but we've expanded into North Carolina and had a few in other areas of the Southeast as well that we view as the starting place and entry point into trying to create the same effect in those markets.
Okay, got it. I definitely have noticed when I'm playing around on some of those other platforms that there's one or two companies in the Southeast, if they even let you search by geography, which sometimes they don't even let you do that. So it wasn't easy to build up anything local that I really wanted to spend a lot of time on. So I don't do it very often. I can see why that would be more appealing from a local angle.
I would argue they are more local. Those other platforms are still more local too. They're just localized to the West Coast or to New York. A lot of their deals and their investor base is going to be local to them. Right, so in some ways, there's similarities in our approach. We're just attacking that from the standpoint of we want to serve the Southeast very well, as I think they're doing a good job of serving Silicon Valley and those types of businesses and investors well. We're not going to play in that world. And I think we'll be better at doing what we're doing. I think we already are.
Yeah. Got it. I mean, I don't know what sort of market statistics there are, but I think I saw fairly recently that you guys were one of the biggest of these platforms in the country, sometimes, depending on what's going on in different markets, different times. But I mean, you can build a big, a substantial presence in this space by being a regional focused player, right?
I believe so. I think those that it may be hard to jump in and get some momentum at this point, but those that have gotten some of the experience under their belt, built a good platform and an early base, just lost my light, then I believe there is a very good opportunity for that. So we've seen that, and I think that'll continue to grow. I think this will be, you'll have key players that are very good at different areas of using this exemption and the tools.
Okay, got it. And this is tangentially related, but there used to be some platforms that were just within a single state. I think because you were allowed to do offerings within a single state without being regulated by the SEC or in the same way. Am I misremembering that? And did those platforms still exist, or did they go away?
It's been a little while since I've thought about that, but before the national exemption, the RegCF was in place, there were some states that were a little bit more forward thinking on wanting to use this type of capital raise and allow non-accredited investors to participate. So they ended up being inherently local by following state rules instead of national. Very few of them had any success. It was still kind of clunky and early. So the marketing needed, the companies that could come in with the technology and all of that to facilitate it well. I never really got off the ground from what I saw. I think Georgia was one that was earlier on. So one of our Southeast representatives there. And I think they had little nuggets of success, but not anything sustainable. I believe a lot of them were using what they were expecting to happen on the national level as their blueprint, and just while waiting and getting a little impatient because it did take a while, said we need to do this. This will be good for the economy. This will be good for our markets, and really tried. So a lot of kudos there. I think it was not necessarily a sustainable model in that way, versus now we're able to leverage the national securities exemption and uniform rules and application across the states that we can serve well, and you can have investors seamlessly participate in a variety of markets as well. So I think it's a good way of going about it by having that as our umbrella while we can still have a more localized approach.
Okay, got it. As a person that likes to invest in things, how much does it cost me to join the Vicinity platform, and what is the size check that you expect me to write in these companies?
Right, great question. Nothing to join. You can join and start looking at deals today very easily, and we can send you updates on anything that you're interested in as well, whether testing the waters or an active investment. The investment levels, usually the minimums are going to be somewhere around $1,000, maybe $2,500. So pretty accessible. Then my feedback on check size would be whatever you're comfortable with. So we're not investment advisors, and I think there's good guidance around the educational side of thinking about this asset class and how you want to make this part of your portfolio. But ultimately, would be a decision that every investor can look at and follow the guidance there.
So you can accommodate unaccredited investors who can only invest a relatively small amount through that structure.
Exactly.
Yeah. Okay, got it. Just back on rules, because we love securities exemptions and rules. What are the key rules that an issuer has to know before they embark on this? I mean, they can talk about this publicly, right? So that's one rule that a lot of issuers in the private angel space mess up because they start talking about this publicly. But you can do that. So that we've checked that off the list. What else in terms of rule following do issuers have to know?
Yeah, the biggest one. So we provide a lot of guidance on what disclosures and just best practices need to be there for the legal documentation and the Form C, which is the actual filing document, like a Form D for different securities. You have a Form C, and it's templatized, so you just follow it, fill in the blanks, get some help from an attorney on what risks and disclosures need to be in there. There's financial disclosures as well, so that's something that would be a part of just the entry point on getting your deal open to accepting checks. I think removing the restriction on public marketing is huge, but then it adds the piece of knowing how to do that right. You can still say the wrong things. You can be overly promissory. You can mix and match messaging that you shouldn't. So we have promotional and advertising guidelines that we help an issuer with to understand how to speak about it publicly. You get to take advantage of that opportunity. So I think if you follow the guidance of the Form C and you follow the guidance around how to promote your deal, then the rest is pretty straightforward.
Okay, got it. And I know it's not your job to do the advertising for the issuers, but is there one on the platform at the moment that you think is interesting and would like to tell the audience about?
Sure. We have to be very objective in the way that we view and display anything on our platform. But one of those criteria are those that have strong momentum. So we have one deal. It's called Windjammer Sailing Activities. It's a very cool story. Whether somebody would want to invest or not, it's great to read up on. But they have a significant amount of momentum towards their goal in the early part of this year. And there's a few others there as well that are local opportunities to Greenville. That one's a little different, southeast, but outside of our market here as we're expanding. But there's some really fun ones to look at and get a flavor for how this works and what type of structures are on our platform.
Okay, got it. Obviously, people in Greenville and nearby will see lots of Greenville deals. If you're in another city nearby, where are you prioritizing your efforts to find new cohorts of investors and interesting investment opportunities?
Right. Well, we've loved being able to work alongside Venture South and the markets that are there because of the interest and overlap in alternative investing, even though there's a different assets within that umbrella that are represented. But that's part of the benefit of finding those that are already participating in alternative investing and even want regional or more local opportunities, all of the tools needed for that. So I think there's good feet on the street and referral networks there where people locally in a Chattanooga, in a Greensboro, in a Charleston, wherever it might be, can look and start to find, hey, this might be a cool opportunity. I know about this business. I know about this brand. They're awesome. Let me see if I can make an introduction. And we love those. You can call me, email me directly, and I would love to set up a conversation with those types of local opportunities or potential investors that want to see this grow in their city and in their region.
Okay. Great. Thank you, Josh. We will definitely have you back on the show soon to talk about some of the things that Josh and Paul are working on together as a result of this conversation. But I thought it was helpful to help listeners understand what the wider industry of crowdfunding and the rules and all of that is about. So thank you for doing that, and we'll look forward to talking again soon.
Great. Thank you, Paul.
Thank you for listening. Visit us at ventureinthesouth.com for a complete list of previous and future shows.